Welcome to Trust Across America, hosted by Jordan Kimmel. This program is rebuilding trust in business by highlighting organizations that are doing the right thing with regard to accounting, governance, finance, organizational behavior, and sustainability. You'll learn about some of the best practices being used by the top companies right here in America. Now, here's Jordan Kimmel.
And good morning and welcome back to Trust Across America with me, your host, Jordan Kimmel. And as we've done throughout the year, we reserved a full hour for special guests when there's a topic that we think there's enough content that we really should spend and really drill down as far as we can. Since we started the show, we've several times touched on the points of the combination of how companies actually govern themselves, their trustworthiness, and their actual relationship to the long-term values of the company. And who better to have on to talk about this? We're pleased to bring on David Koenig, and David just wrote a recent book, Governance Reimagined. He's also a tremendous history in terms of the market valuations of companies. A lot of places he's been, a lot that he's done. First, let's welcome on David. And David, thanks so much for joining us.
Jordan, thanks so much. It's a pleasure to be with you.
All right. Well, listen, it's really a pleasure to have you for the whole hour. And I read your book, Governance Reimagined, cover to cover last month. And your bio, frankly, is a little bit too long for me to read through. There's some great highlights to it. Why don't you take 2 or 3 minutes before we get into the subject of your book and the talk today on where you've been and what you've done and kind of how it all weaves to where you are today?
Sure, happy to. I think now this is about 26 years I've been involved in the financial markets, beginning in the mid-'80s in Chicago, working for a bank that no longer exists called the First National Bank of Chicago, or First Chicago, which was absorbed into the J.P. Morgan Chase world several years back. But in that work, and I think in the academic work I was doing prior to that, my interest has always been in how risk is priced and how risk affects what people do. So in that work there, we helped clients around the world restructure their portfolios, how their businesses operated, to neutralize some of the external risks they had, like foreign exchange risk, interest rate risk, things like that. That led to some work where I was actually engaged in developing risk management programs for 3 different companies. In fact, in the mid-'90s, I led the development of what we would call the first enterprise risk management program in the mortgage banking industry for a company called Principal Financial Group. And the objective there was to understand our risk better than any of our competitors. The idea being, if you understand your risk better, you'll take risk more confidently, you can pursue your objectives of your business better, and had quite a bit of success there with that company. A good group of people to be working with, and the end result was quite good. Moved up to Minnesota, built risk management programs for 2 different companies here, including U.S. Bancorp Piper Jaffray, which is a medium-sized broker-dealer based in Minneapolis. Same kind of concept, trying to integrate an understanding of risk and how the business operates and help the business run better. Had a little detour in my career where some people, colleagues of mine around the world, started a professional association of people who do risk management called the Professional Risk Managers International Association, PRMIA.org, I think is the website for that. That's an organization that now has members, I think, close to 80,000 in just about every country around the world. The goal there, again, being to help companies understand risk better so that the systems in which we work and the companies that we work for and all of our organizations can be run better. And then about 3-4 years ago, started this company called the Governance Fund Advisors, with the idea being applying that understanding of risk and some of the drivers of risk and its effect on valuation of publicly traded companies. What we could do is try to find interesting investments in the publicly traded markets where risk isn't fully appreciated, both reduced risk as well as higher risk than the market understands. So that's where we are today. I wrote that book that you had mentioned that came out in May of this past year, and really what I tried to do in that book was to bring together all of those experiences, all of those concepts through work that other people have done in my own work as well, and put it in a coherent framework where people can see how all of these factors affect the success of what they do and what they can do at their organizations to try and make them more successful. So that gets us to today, and hopefully that's a helpful introduction.
No, it's a great introduction, David, and it helps the listeners understand why, when we get into all these subjects, as we will throughout the hour on risk, and understanding that risk goes well beyond financials, and whether people are calling them now extra financials or non-financials, certainly there's a lot that comes into play. And let me kind of, jump right into it, because I think it's the crux of a lot of what you do. There is a very clear intersection that people are just finding right now between value and values of a company. And why don't you kind of jump that off from some, like a $20,000 foot level to start with?
Yeah, I'm happy to. It's an interesting conversation I think most people don't have, because values are such a nebulous concept, and they are defined by individuals, by corporations, by nonprofits. Even you could argue in political economies, if you want to define the values of the United States, you could do so. They're not applicable to each individual, but collectively, they're a set of values that we would hold as our sort of defining objectives, the things that we want to see achieved and the things that we believe in collectively. Value, on the other hand, is something that people perceive as what they receive from an exchange with someone. So, for example, if I go to a grocery store and I buy something, what I get back from that is something that satisfies my hunger. That's the value I get from that transaction. And the store, on the other hand, gets value back from the money that I give them for that transaction. Mm-hmm. So what we're trying to do, I think, ideally, in a world of good governance, is to try and align those values with the creation of value for all the people who are involved in the transaction, or all the people who are involved in organizations, directly and indirectly. And that conversation ultimately comes down to, what do you believe in, and what is it that you get from a relationship with someone? What do you get from a transaction with someone?
Right. And David, we should stay on that point for a little while, because I think that this extreme notion that quarterly earnings are what drives my company and the most important thing to me, I think stems a lot from the large bonuses that began accruing to senior management based on the closing price of a given quarter. And I want to tie it into something that you're calling complexity economics early on in your book. And you mentioned, hey, there is no real random walk. It's not a matter of simply diversifying among all stocks, that external things affect value, and it goes it's a discussion way beyond earnings. Tell us what you mean by external things affecting value.
Yeah, I think if you're looking at how your organization works, we tend to be focused on the people in the company. What do your workers do? What is it that they achieve? How do you motivate your workers? You talked about bonuses briefly. We can spend some time talking about how bonuses work and whether those financial rewards are actually what people drive, or what drives people, whether it ties into their values or not. But the external factors that I mentioned in the book are a recognition that any organization operates in a very complex network of people who are interested in how that organization does. So if you're looking only internally at employees, you may be looking at customers. That's a pretty common extension of this. But customers are external to your organization, but so are suppliers, retirees, regulators, competitors. All of these people have an interest in how your organization operates. And if you have any relationship with them, maybe competitors are one that would be an exception to this. But if you have a relationship with a supplier, you need to be concerned about the things that drive the decision of that supplier as to whether they want to do business with you. So external factors that impact, whether it's I think it's tougher to talk about a stock portfolio this way than it is an organization, but external factors that it can affect the value of the organization can be as simple as whether a supplier decides not to do business with you anymore, or if a supplier raises their costs of doing business with them. So they want you to pay them in advance as opposed to pay them upon invoice. Those kinds of relationships affect your ability to ultimately meet your values. So we have to pay a great deal more attention to them. You mentioned complexity economics, and this is something actually that is, I would say, relatively new in terms of a study of economics, but as I said in the book, I think this has the potential to change our understanding of economics permanently and for the better. Complexity economics recognizes that all organizations and all things that we do in our economic life and our social life involve networks. And these networks are people, they're utilities, they're technologies, there are other systems and networks. And they all have to work together in a way that defines whether something can achieve its goals well or whether it fails to achieve its goals. They do a nice job of explaining how economies emerge. Complexity economics does a great way of explaining how income is distributed in a way that some of us would describe as being unfair, because they see that there's a vast difference in what's distributed, if that's the proper term, to the top 1, 5, 10%, whatever it might be. Mm-hmm. But in complexity economics, they have ways of showing how that happens. It's not necessarily something evil that happens. It happens because that's the way people interact. So this is, if we wanted to spend a good deal of time talking about complexity economics, I don't even think we'd scratch the surface of it. But the bottom line is complexity economics makes up for a lot of shortfalls in the traditional way that most of us have been taught economics in the last 25 years by examining how people interact in systems and networks and how that leads to the generation of value. And I would encourage people to dig further into it. Just quickly mention a group called the Santa Fe Institute in Santa Fe, New Mexico. That's really the hub of where this research is happening. And if your listeners want to learn more, I just tell them to go online and search the Santa Fe Institute.
Right, and terrific. And my plan was to kind of spend a little bit more of our next segment, frankly, on this thing that Risk Capital has Common, something you've won an award for, and I think that's worth kind of delving in a little bit extra when we do that. What I wanted to do before we did that, though, because we're going to come up to a break, and that's a pretty meaty conversation. I didn't want to interrupt it. So what I think we do right now, and you made a very good point between kind of distinguishing between stock market returns, and organizations, but we'll get a little bit into the relationship of that later on. Before we take our first break, we're just a minute ahead of it, why don't you spend, I know there's a couple different groups you've already mentioned, some of which you're affiliated with, some of which you manage yourself. There might be a couple of different websites you want to share as the conversation goes along. So let's take a pause here, David, and first share a couple of websites that you'd like people to get more familiar with.
Sure. In fact, I'll direct people to my website, davidarkoenig.com. So it's first name, middle initial, last name.com. And that'll give you links to some papers you can download, previews of the book, other resources. I think that's a great starting place. I had mentioned the Professional Risk Managers International Association. For people who are very specifically involved in risk management, that website is PRMIA, M as in Mary, .org. And there are lots of great resources on that site. And I mentioned the Santa Fe Institute. I don't have their website URL handy, but again, if you just go in and Google Santa Fe Institute, it'll take you there. Lots of great research, and they've also got some excellent TED Talks on video that are out there if you want to get the short version of what they're doing.
Right, terrific. All right, well, let's do this. Let's take a quick break. We're with David Koenig right now, the author of his new book, Governance Reimagined. There's a lot to cover throughout the hour. Let's take a quick break. We'll be right back with more Trust Across America after a quick break.
Now, back to Jordan Kimmel.
And welcome back to Trust Across America, where we're David Koenig, and we're talking about governance. We're talking about its relationship, in fact, with public companies' valuation. And David, the listener group has gotten very familiar with something we call FACTS, which is a multi-factor model that looks at financials and extra financials to look at how to distinguish companies from one another. You talk about something called the value equation, and three things, and there's probably more that affect the role of governance. Why don't you kind of get into what you're calling the value equation?
Sure, and I think that when we hear the word equation, hopefully we won't lose too many listeners on that. We don't want the math to scare anybody here. In fact, this equation is very simple, but it applies to just about every relationship that we have. The value equation simply looks at how we decide whether we're going to engage in some transaction with someone. Now, that transaction can be as simple as a friendship, or it can be an investment in a stock, or it can be an investment that a company makes, or who you vote for as a political candidate. So you're really, in the end, trying to come up with some way to describe whether something makes sense for you to trade your time, trade your money for.
Mm-hmm.
So the value equation has three components to it. The first component says, what do you expect to get from a relationship? What do you expect to get and when? I mean, if I get something from the store where I mentioned that I went to buy some food, I know when I'm going to get it. I know when I'm going to eat it. So that's going to give me a sense for where I'm going to get that. But if I own a stock, it's going to pay me dividends over a particular period of time, or if I make some other investment like that, it's going to pay dividends over time. The second component of this is, for how long do I expect to get something? So am I going to get it just once? Am I going to get it for 5 years? You may sign a contract with a company that's going to clean your house every 2 weeks for a year, something like that.
Mm-hmm.
You have to define for how long you're going to get something. And then the third component, and this is probably the most underappreciated part of this equation, is what's the chance that you're going to be disappointed? So you have expectations of what you're going to get. So you decide to go work for a company. They're going to pay you every 2 weeks. You might expect to be working at this company for 5 to 10 years or your whole career. What's the chance that you're going to be disappointed with those expectations? Now, that disappointment is one way of describing loss or risk of a negative kind, so a negative risk. And this whole notion of governance, this whole notion of governing relationships and organizations, is that you're trying to maximize this value equation, and you do that by increasing what people expect to get from you, increasing the amount of time they expect to get it or the number of times they expect to get it from you, and reducing the chance that they're going to be disappointed. Those are the three things we try to focus on in governance. So we call it a value equation because there can be lots of math behind it, but we don't have to think about it in that specific way. We can talk about it in this sort of qualitative way as well.
Right. So I think what you're saying here, I think, is that everyone's kind of going to look into the potential relationship and give their assessment of what is the real risk of these particular items either being satisfied or dissatisfied. And I guess the thing is, other than trial and error, how would a company I guess the question comes into the difference between being trusted to deliver and being trustworthy. How does a company become that trusted factor in this process?
Well, let's assume there's nothing known about the company. So let's take this cleaning company, for example, because that's one of the examples we use in the book. Suppose you know nothing about them other than you saw an ad in the newspaper. None of your friends use that company. You can't find anything online. You might sign up on Angie's List and see if there's any information there about them. And there's nothing. You have a high degree of uncertainty and a very low level of trust. And so the amount of money you're willing to pay that company in advance to clean your house for a year is probably going to be substantially less than if all of your friends use that company. There's lots of information about them available that's transparent. The Better Business Bureau says great things about them. All of those things that help build up your trust in that organization and then reduce the risk that you're going to be disappointed. You have a pretty good sense in that case of what they're going to do. So what you expect them to do in terms of taking care of the house, for how long they're going to do it, that's the length of the contract, and you hope that they'll be in business that whole time. But the trust element, and this is something that in the book, is a pretty central turning point in the book. Trust is extremely important in every aspect, in every relationship that we have, because it is, again, this most underappreciated component of the value equation. So organizations trying to increase trust, have to make sure that they're very transparent in what they're doing so that there's a reduced risk of missing on people's expectations. They need to recognize that they operate in a social network, for lack of a better term, in that people will talk about them. People will say things about them. I mentioned Angie's List in the other example, but when a company has a relationship with a particular customer, that customer doesn't live in isolation in that relationship with that company. That customer has relationships with all sorts of other businesses that are like them, with suppliers that they may share with the company at the focus of the discussion. They can get all sorts of information about that company without that company ever even knowing it. Mm-hmm. So if that company, for example, has a bad relationship with, let's call them Company A, but Company A has a great relationship with the CEO of Company B, and they're trying to get business. The first company is trying to get business from Company B. They may find that it's really hard to do because the first company is saying so many bad things about them. So one of the things to do in terms of trying to build up this trust is to start to map out what the social network is of the organization. And this is an area of science called network theory and systems theory. They're both related, only network theory tends to put it in a pictorial manner. And it's really understanding the power of relationships that you have. Where is it that you have influence with people? Where is it that you're trusted? And all of those eventually, the higher level of trust, the greater influence you have, all of those reduce the cost to you of trying to get something from other people, try to get capital from other people, whether the store is trying to get money from me when I'm buying my food there, or whether you have to pay, when you're trying to hire somebody to come work for you, when you're out trying to acquire new customers, or take a politician, for example. A politician is trying to get something from you, which is your vote. They have to try and address the trust issue because you don't want to be disappointed if you elect somebody for 4 years or 6 years or whatever it might be. You'd like to have a high level of trust that your vote, which is a piece of capital, a piece of economic capital that you have, that you're trading for this person to have some political authority over you. You don't want to be disappointed in the use of that. So trust is central.
And I think that's a beautiful way to put it. And I also mentioned, I want to tell the group that we spoke, soon after I read this book because you address trust in a way that I hadn't heard anyone do, and I want to kind of combine that with another thought. You talk about really trust being a keystone, which is such a great word to use and such a graphic word. And then there's another piece where you talk about that maybe the secret, and I guess this would go to the distributive network idea, that eliciting the cooperation from others instead of trying to conquer those others. I think that actually kind of, they fit together in a way as I hear you talk.
Yeah, the keystone that you mentioned for people trying to visualize this essentially is the essential element to an arch. An arch is a very strong structure, but if you have this one stone in place at the very top, angled so that it brings the two pillars and the top curves that come together in the center, it's an extremely strong structure. But absent that keystone, it's incredibly weak. You can knock that over with just a simple push, again, depending on the size of it. But I mean, the visual is, without a keystone in place, the structure is worth nothing. Mm-hmm. With the keystone in place, it's incredibly valuable. Now, trust can be viewed as a keystone because in order for a relationship to work, trust has to be there. And what we find you mentioned, I think, this distributive notion, this distributive and networked governance notion that we build on in the book, or that I build on in the book. The idea within that is that you want to give people the freedom to innovate. You want to give people the freedom to take risks, and you want to do it in a way that they feel empowered, but at the same time, you have the responsibility to make sure that nothing they do puts the entire organization at risk. That trust that you have to have in that person or that group to which you're distributing this authority is a keystone. If you don't have that trust, you won't do it. Now, if you try not to distribute the authority, if you try to keep everything very centralized, one of the things that you lose out on, and this is, again, getting back to this notion of complexity economics and systems, you lose out on all of the value that comes from these relationships that you have, all of these ideas that come in through networks, all of the ways in which you can improve your business because other people are sharing ideas with you or they're sharing ideas amongst each other within the organization. You lose that because you haven't given people the freedom to act on those decisions. So now let's take it from the other side. That's the organization allocating out this distributive accountability or this distributive authority to take risk. Think about it from the receiving standpoint. If you're an employee in an organization, do you trust the organization to back you up if you do have a failure? Do you trust the organization to give you the support you need to be able to achieve these goals and to take some of these chances? Corporations, if they don't give people that sense of trust, won't see the innovation because people will be too afraid to take risk. And one of the things I think we should talk about, and I know we're coming up against another break here, but maybe we could talk about this after the break, is just what that impact has on people's decision, that notion that there's a big risk that something is going to happen to them, like they lose their job because they made a mistake. It has a huge impact on how effective organizations can be at distributing out this ability to innovate, and ultimately how they create value. Because value doesn't come because somebody in the CEO's office says, go do this. Value comes about because people come up with new ways of building things. They come up with new ways of delivering things. They come up with new ways of serving clients. And that usually happens at the very ground level of an organization where people face the networks that we've talked about. You face the customers, the suppliers, the delivery people. That's where the best innovation comes from.
Right. No, I think that's really worthy to build on, and we will do that after the break. And to your point, there's so much discussion about the average employee in large companies around the country where they're so little involved on a day-to-day basis mentally when they walk in. And it has a lot to do with the fact of how empowered they are. Can they make snap decisions? Can they allow themselves to really get involved in decision making? I think it's a beautiful point to build on, and we'll do that after the break. We're with David Koenig. It's a great discussion on governance and maybe even governance reimagined. I love the title, David. So let's take a quick break. We'll be back right after this break. We'll be back with Trust Across America right after this.
Now, back to Jordan Kimmel.
And welcome back to Trust Across America. And we're talking with David Koenig. And David has actually won a really interesting award just a couple of years ago. And it goes into really the essence, I think, of the conversation about risk, about networks. And let me see if I get this right. But David, your idea of risk capital as commons, distributive and network governance, I know that's actually something that won an award for Management Innovation Exchange M-Prize, which I think you should be very proud of, number one. But let's talk about how that actually plays out into not only companies but organizations, and I'll let you kind of lead off on that.
Sure, and thank you for that. I appreciate it. Yeah, it was very interesting. It was the first management innovation competition. Gary Hamel, who's a professor at Harvard, has something called the Innovation Exchange or Management Innovation Exchange online, and they've got some really interesting competitions that go on where really they're out crowdsourcing ideas for how companies can run better, and this was one of the ones chosen in their very first competition. So I was quite surprised and flattered and pleased, so thank you for mentioning that. Risk capital as commons gets to a notion that dates back a ways. There was this, I think people are familiar with this notion of the tragedy of the commons, which is a very negative way of looking at how things that are commonly available to people but are valuable to them can often be destroyed. So a couple of examples that are most frequently cited are water or the air. So if you have a lake where you have lots of people living on that lake, or have access to the water for industries, whatever it might be, what tends to happen is that water is valuable to people. But if there isn't a sort of regulatory mechanism in place or some mechanism in place to protect it, it tends to get overused. I mean, if you have no cost to using it, you want to use as much as you can, and the resource tends to be destroyed. We saw this in the 70s with air quality, when factories were not being charged or not being required to reduce their emissions because there was no cost to them. They would just belch as many chemicals as they needed to into the air, but all of us share the air. So that commons was being destroyed. So the notion was always that there's this tragedy of the commons. There's only two ways to deal with it. One is to regulate it. So you have the government saying you can't do something. The other one is to sell it, privatize it, and then make a company use its profit-seeking motive to turn that into something that works well. Well, it turns out there's actually a better alternative, actually, one that turns out to be more efficient than this, even this privatization concept. Elinor Ostrom, who recently passed away, was a professor at Indiana University, won a Nobel Prize a couple of years ago, for her notion of how commons could be managed effectively by the people who own it. There's a whole set of principles, and I won't go through all of them because they're listed in the book and they're in her papers, and each one of them needs to be developed, with some backing to understand them. But the general idea is that people will, if given the right structure, self-enforce the management of a commons. So people who live on a lake, let's say it's a resort lake where people have cabins, or it's a town where people get their drinking water from the same place that industry uses the water to run its factories. If they're given the authority to take care of it, and they understand it, and they understand how it works, they will actually do a more efficient job of managing it than the government will, or than a private owner of that particular resource. It's a fascinating outcome from this research. So we have to turn this then, and the idea of creating this risk capital as commons notion is that any organization has a limited capacity to take risk. Businesses exist to take risk. There's no reason to be in business if you're not going to take a risk, but you're limited in how much risk you can take. And you might be limited by regulators, or you might be limited by the amount of capital that you have, the financial capital that you have. If you're an entrepreneur, you have a certain amount of money that can help meet the cash flow needs you have at the business. If you're a publicly traded company, you've raised equity, or you might raise debt in the private market. So you might have received money from a venture capitalist to keep your business going and see it expand. But you're limited in the amount of things that can go wrong for you. Again, looking at the negative side of risk here. So if you're trying to manage that capacity in the best way possible, you might go to Elinor Ostrom's concept and give people ownership of that risk. So that doesn't mean just at the board of directors level. Rather, what the board of directors is doing is trying to say, these are the values of our organization, and this is how we're going to measure our value. What we want to do is to say, this is the amount of risk we're comfortable taking. Now, you, CEO, you go out and allocate this amount of risk. And again, it's a very long conversation about how you define what that risk is. But you allocate this amount of risk out to the people who you most trust to use it well in the organization. They might then allocate it out to different business lines, to different products, however it is that the organization is structured. And that division keeps going on and on and on throughout the organization, so that you start getting a portfolio of very small groups of people. And very small can be, 150 or 200. It might be 5, but it can be 150, 200 people where this is allocated. Each of those groups are empowered to take risks. They're empowered to take risks within the limits that are set for them by the group higher than that. None of those risks is big enough to take out the entire organization. None of those risks is big enough to severely damage the ability of the organization to meet all of the other promises it's made to suppliers, customers, et cetera. But each of those groups is empowered to innovate, and some of those innovations become very big. In a way, what winds up happening with this concept is that you create a portfolio much like a venture capitalist does, in that they take lots of experiments, they make lots of small investments, and some of those investments do really well. They invest more in those and they flourish. And in fact, some of those then might get divided up into new groups of innovation. But even if, say, 8 out of 10 of those ideas fail, the 2 that succeed tend to succeed so well that they more than offset the cost of the failure on the other 8. This idea is of constant innovation, of small experiments, and of treating this ability to take risk as being commonly owned within subsectors of the organization. That means they have control over decisions within the group as to how to take the risks. They have the ability to meter out rewards for how the risk has been taken. They have the ability to meter out punishment for people who abuse the authority that's been given to them. And then they have people from outside that group, usually the ones that have allocated the risk-taking capacity to them, to monitor and intervene when necessary if it feels like the organization's larger goals are not being achieved or not being addressed by that group. So it's a way of giving freedom to people to innovate, to take chances, again, in this environment where that's trust, that they're not being punished for doing that because that's what the organization has empowered them to do. Risk capital then becomes commonly owned by subsets of the organization. And again, with the research that Eleanor Ostrom did, what we find is that that's more efficient than what people would consider to be the market-based solution, this free market concept. It's more efficient at using that capital, and that's quite amazing.
Right, and it also ties in, David, a couple things that you mentioned, including using your network. And in this case, you're using the networks of the tiers maybe below the very top senior management to say, take these risks. You guys are on the line. You're on the floor. You're on the front lines. You could probably figure out how to do it better. And again, these are the ideas that would not come from the folks sitting in the proverbial ivory tower, right?
That's correct. Absolutely. I mean, the best innovation comes from the people who are closest to the source of the risk or source of the revenue.
Right, and I guess that this is, that example would be one of the best examples of really empowering the employees. And again, there's so much of a discussion that individuals are seeking more and more to work at places, not only for the wage, not only for the bottom line, but the question is, how do I feel walking in the organization? Do I feel as if I have an opportunity to grow? And if I'm just collecting a paycheck and I just am told what to do at every turn, well, how motivated could anybody be in that organization?
Yeah, and I think what you're getting to is some of the stuff that Daniel Pink has written about, which is what it is that drives people. The monetary drive is there for some people, but it's not there for everybody. A lot of people look for rewards that are more about satisfaction. They're about growth. People who are in management often like to feel like they're being invested in. So it's a very inexpensive thing to do in-house training for people who you're trying to develop in a management capacity. And those people feel that you have made a decision to invest in them. It's actually probably less expensive to do that than it is to give them a cash bonus. It probably has a greater impact on their level of satisfaction at some level. And in addition, you're investing back in the company and you're investing in the trust that they have in you because they see you making that investment in them. They feel like there's a commitment from you to them. They'll make a greater commitment back to you. I don't want to make this sound in any way like the reasons you do this are because it's all about you. But in the end, every organization exists, as I mentioned, to take risk, but it takes risk in pursuit of some set of values. And what we're really trying to get at here is what is the most efficient way to realize the fulfillment of the values that brought your organization to fruition in the first place. Why do you exist? And this whole concept is whether it's, again, it could be a party that you're hosting in your house. Political economies, businesses, nonprofits, all have something they're trying to achieve. This whole notion is how do you get to a place where you achieve that most efficiently and generate the most value for everybody who's a part of your network.
Right. No, I think that's a great way to catch it. What I want to do, too, after the break, there's something maybe that ties it in. And, again, you're talking about things that go well beyond public companies and well beyond the value of individual corporations. But the concept that you're bringing up a number of times about risk, I think, is really, really important. And the reason I want to tie that together is I think that years ago, David, when we created Trust Across America, we said that all this negative press in the market would lead people away from the market, that when the economy got stronger, people would still say, well, look, I'm not going to invest because I don't trust companies. There's too much risk, not only the risk of missing earnings and declining business, but the risk of behavior. And I kind of want to tie that together where I think you're using your valuation, your value equation, and you're looking to actually reduce the risk on the left tail of opportunities and maybe positively skewing your outcome of evaluating companies. I think we could tie that together to wrap it up. What we're going to do is we'll take a quick break right here. We're with David Koenig. David, maybe one more time you want to just shoot out your main emails before we come back.
Sure. I think if anybody goes to the website, davidrkoenig.com, you'll find links to get in touch with me, and then the easiest way by email is david@davidrkoenig.com.
Right, and let me just make that clear for everybody. David's last name is Koenig. Let's make it easy to find him. And David, we'll take a quick break, and we'll kind of bring this all together right after this quick break.
Now, back to Jordan Kimmel.
And welcome back to Trust Across America. And we've touched on a lot of different things with David Koenig this hour. And I kind of want to bring this into a point when we first started Trust Across America 4 years ago and said we really need to be able to distinguish different ways companies do business to try to put a mathematical equation on how trustworthy they are. People said, well, hey, wait a second, stop. There's not even a universal, correct, accepted definition of trust. How are you going to measure it? Well, it kind of led to 4 fantastic years of talking to a lot of people. David, I'd love you to kind of weigh in on both this idea of what is trustworthiness, and then secondly, if you can use either your measurements, other people's measurements, to kind of make sure you can try to skew a positive outcome, and companies will do the same thing for their level. So let me kind of jump off. It's a big, broad way to introduce it, but let me let you get the ball here.
Yeah, no, that's fine. And what I want to do is focus on the part of the value equation that we said that is most underappreciated, and that's the part for risk. What's the risk of being disappointed? Now, there are 2, actually, components to this where risk comes in. We most talk about risk as a negative. What's the risk that I'm disappointed that I just mentioned? Mm-hmm. But the other thing in a relationship is that you might actually get more out of it than you expected. So there's the chance that you have a positive upside to this. Mm-hmm. And what we talk about when we talk about something that is unknown, which is a relationship that is taking place now or in the future, has some forward-looking component to it, is that we have a range of possible outcomes. Some exactly what we expected, some better than we expected, some worse than we expected. Now, 2 things in this that matter, and obviously we could spend a lot of time talking about them, but I'm going to focus just on 2. One is that you get disappointed in a very big way. So something horrible happens to you. Your relationship causes you to get sick. The decision that you make ruins you financially. The investment that you make as a company causes you to go out of business. These kinds of extreme losses create an emotional response in people that is only been understood, I'd say, in the last 10, 15 years, but being applied now just in these last few years. But what they've found is that when there's a possibility of a very big disappointment, people request, on average, 2.5 to 3 times the amount of possible upside surprise than they do on the downside. This makes the cost of getting somebody to do business with you very expensive. So one of the things that organizations need to do is to try to manage the possibility and really eliminate the possibility of people experiencing something that's catastrophically disappointing to them. If you don't do that, you wind up with what's called a negatively negatively skewed distribution of outcomes, and it means your organization is worth a lot less than it would be if you just sort of randomly did things. Mm-hmm. So you eliminate that part of the left side of the distribution, as you had mentioned, those big losses. And then you try through this risk capital as commons approach, to this distributive and networked governance approach, to allow people to innovate. Because as I mentioned in that venture capital model, 2 out of those 10 or 3 out of those 10 ideas turn out to be very big things. They turn out to be big surprises, big positive surprises for you. When you allow that kind of thing to happen, what happens is that the right tail of the distribution, that's where good stuff happens. Mm-hmm. The right tail of the distribution is the one that actually is extended, and you wind up with an outcome that's called positively skewed. When you have a positively skewed potential for outcomes, the cost of capital is cheaper to you. It's cheaper for you to hire people. It's cheaper for you to get customers. It's cheaper for you to raise money in the equity markets or the fixed income markets. Everything becomes easier for you. If you're having a party at your house and people say, there's a chance I'm going to have a really great time, it's a lot easier to get people to say yes, they're going to come to your house, than if they think there's a chance they're going to get food poisoning because that's what happened at your last party. Mm-hmm. So these parallels happen wherever people intersect, wherever people interact in their networks. It doesn't have to just be at an organization. Now, you had mentioned your work with other people, and I'm not sure if you've run into Alex Todd or not in your work, but Alex has done work in the trust space. I think the work that you guys are doing in this trust space is really important. Alex has a definition of trust, which I really like. It's short, and it's called acceptable uncertainty. So what you're trying to do in order to get the trust of someone is to get them to a place where they feel comfortable. They're willing to accept the uncertainty of the future of dealing with you. And once they've done that, they agree to transact with you. They agree to become your employee. They agree to buy your product. They agree to supply your company. They agree to come to your party. They agree to vote for you. That's what you're trying to get to. And the more you can make it positively skewed, the possibilities of positive skew, the lower that threshold of uncertainty is, and the easier it is to get people into your network. And I think that's incredibly important. And so bringing it back to the whole reason that your company exists, the whole reason that you have this show, is about creating levels of trust that are better than they are without any of these kinds of structures and any of these kinds of intervention. So we're trying to get to a level, again, of acceptable uncertainty so that people want to be with you, they want to do things with you, and that creates value.
Right. And, I think you hit that right on the head, and I think that what I like, one of the things I like most about this conversation is the desire, the willingness to put this idea right up front, this idea of risk and of uncertainty. And the fact is, we can never really be certain of too many things. And when you bring this into the investment world, well, it makes common sense that if you happen to have a better relationship with your community and a better relationship with your employees and a better relationship with your suppliers even than other groups in your area, well, the innovation will happen. There'll be less of the negatively skewed outcomes, and these companies have a probability of being more profitable in the long end. And all we could try to do is eliminate some of this uncertainty of what are these terrible companies going to do to me by recognizing there are wonderful companies that kind of get the message that there's more to life than maximizing quarterly profits. And I think a lot of that is addressed in Governance Reimagined and in all the different measurements you're taking of looking at the extra financials. I think this is a great hour spent. I really appreciate your time. David, there's a couple minutes left. Why don't you kind of tie it together and give us a send-off right here?
Sure, and I appreciate you mentioning the book. It's available in the online marketplaces like Amazon, Barnes & Noble, and the others like that. So if people want to go online to get that, you can get a sense for the whole way in which it's developed. And I've also got a preview on that website, thedavidrkoenig.com, so you can get a sense for what's laid out in there. The wrap-up is this. You do things because you have a set of values that you're trying to fulfill. Whether it's, again, at your church, in your work, in your neighborhood, whatever it is that you're doing, you're really trying to fulfill some set of values. And everything that we've talked about here, the empowerment, the management of risk, enabling trust, understanding how networks work, is all about helping you to achieve and realize those values. They're not always monetary. In fact, a lot of cases, they're not monetary. This is about trying to help you achieve those better. And I hope people will have a look at the book, get in touch with me, look at the work that you guys are doing, and I think they'll realize more value creation than they realize is possible today.
Right. Well, fantastic. And I'll share with the listener group, I'm as busy as most everyone out there. I took the time. I did read it cover to cover. David, you throw in some nice humor in there as well. I think it's a great book, a great hour. We want to thank you for it. And I also want to mention quickly, the trustacrossamerica.com website continues to aggregate blogs from all the professionals that we've come across that touch this concept of trustworthy business behavior from one level to another. So trustacrossamerica.com is out there. Share the link, and folks, this link here will be permanently up on Trust Across America. Share this link with your relationships. It's all a matter of this ecosystem of trust that continues to grow and react where people know we need to depend on each other. We need to do it in a trustworthy way. So, David, let me again thank you for your time. Let me thank Brad over at the Engineering Control at Voice America. And everyone have a great week ahead, and join us next week right here on Trust Across America. One more time, a big thank you for David Koenig for joining us, and have a wonderful week ahead.